Happy Monday, everybody. All right, last week the Fed met. They met to discuss rates, and everybody's been hoping that the Fed would lower rates. Why do people want lower interest rates? Well, so that they can borrow more money for cheaper. So think about if you're if you're in the market for a new home. Interest rates are now at one of the highest levels they've been in the last 15 years. Now, that's not high historically speaking, but compared to the last 15 years, interest rates have been high. And so that means if you're shopping for a house, you might just hold off and wait until interest rates drop. Or if you do buy a house, you might have to buy a less expensive house because you can only afford so much mortgage payment a month that you got to go with whatever rate you got. But that means that the more expensive homes aren't being sold, right? So, and that's not just in real estate. It also applies to business loans, to auto loans, everything. So, folks have been wanting interest rates to drop, and economists have been wanting that to drop because that means that borrowing will increase, and then the velocity of money will increase. Well, the problem with raising or lowering rates is that it could boost up inflation again. Because if things are cheaper to go buy, then that just incentivizes the sellers to raise prices, right? Which is a factor of inflation. So the Fed met last week and they didn't drop interest rates. And oh my goodness, the stock market was coming down. And meanwhile, you saw if you're an investor with us, your portfolio was going up. Now, let's look at why. A few of the Fed governors spoke out about the Fed's decision not to lower interest rates. Basically, they said it's because of uncertainty. Now, bankers love certainty. They love a boring White House where they know all of the next turns that are going to be made or not be made so that you can predict how things are going to flow. And right now, specifically driven by the risk and threat of tariffs, nobody knows what's going on. Now, last Friday, Trump said, we're going to hold off on some of these tariffs. So whether there's going to be a tariff or not is uncertain. And that uncertainty is driving the markets crazy, but it's driving the Fed to say, you know what, we're not going to lower interest rates because if these tariffs do come into play, that might have an upward impact on inflation, and we don't want to make that worse with lowering interest rates. And so it's really all about uncertainty. Now, this gets back to our investment strategy. Uncertainty is not a great environment for the stock market to perform well in, but uncertainty actually drives money to hard assets because in an uncertain environment, you want to hold things that are hard to come by, that are natural resources that everybody needs and are in limited supply, which gets back to the hard assets that we are really fans of investing in right now: precious metals, natural resource, commodities, food. So it's having a positive impact. And that's just because of the uncertainty, not to mention the supply and demand that is automatically driving those up. The uncertainty is actually where the hedge comes in tough economic times. So fascinating. The uncertainty means that these videos, who knows where we'll go. It's always fun reading up, seeing what's around the corner, and giving you guys an update. So that's it for now. If you like this video, give it a thumbs up, subscribe to the video, and we'll see you next week. Take care.